attending today. I'm Gary Forster. Next to me is Brian Page. Right? I can't. We try to move the people around to go under the name, but it looks like we're opposite now. Anyway, I'm Forster. That's Page. We're going to talk today about tax expatriation, which is the movement of people and assets out of the United States. We've been kind of inundated with several matters involving the movement of assets. A lot of people are coming into the United States. A lot of people are leaving. So there's just a lot of movement in both directions. A lot of these movements trigger a tax event, which is very, very misunderstood or completely unknown to even the CPAs out there. There are taxation upon exit of both people and taxes. And we just wanted to present an overview. There's quite a lot of issues and topics, but we want to take 50 minutes to give you a good overview of what's entailed, what you should look for, you know, what are the red flags that may arise, and then, you know, how to address them, at least initially. Let's go to the agenda. You can see there's a lot of different subtopics. We actually, we recently did a book. I did a book on this taxation of the estate and gift tax for the non-citizen. And then that's been converted into a case book, a law school book, which we can provide anyone if they like. I just wanted to say that at the onset in case I forgot, because there's a section in the book on expatriation. There's also a section on foreign trusts, which deals somewhat with moving assets offshore to foreign trusts. That gives you a written overview. We can send you an outline. We can also send you the program. But if you want a little written overview, a summary, we can send you the book as well. I'm speaking pretty loud. I don't know if there's a way to get the volume up somewhat. Where's the? Let me move the disc a little bit. Let me move it. We're gonna start with expatriation of people, which involves U.S. citizens renouncing U.S. citizenship. Very uncommon, actually. It's a very, really a remote issue. The real issue is the expatriation, the quote, expatriation of long-term residents. Long-term residents, non-citizens who go back or go to another country are subject to a number of taxes, and one involves income tax and a sale of all your assets, and the other one involves an estate tax if any assets come back into the U.S. We'll spend probably 30 minutes on those two taxes and how they impact citizens and long-term residents who leave, both on the income and estate tax side. And then we'll talk about foreign trusts and what happens when we fund foreign trusts. What happens when we move assets offshore to foreign trusts, both from a resident / citizen side and from a non-resident alien, a non-resident, non-citizen side. And that's kind of the order we'll go through for the 50 minutes. Expatriation, it essentially is what you would think it is. I'm going to let Brian work through the options on expatriation, but you know, for U.S. citizens, it's a process. It's an immigration naturalization process where you say, I don't want to be a citizen anymore. As I noted, it's very uncommon. Much more common is, okay, I am a long-term resident. I'm subject to U.S. income tax on my worldwide income. I want that to end. I want to go back to my original country or to another country. I want to give up my green card, and I don't want to be subject to worldwide tax on my income. As a backdrop, because I think that kind of drives a lot of this stuff. I've been doing these since 97. I mean, I know it's like incredible. Like that's like, it's amazing how old I am at this point. But I mean, it's like, you know, I don't feel that old. So in 97, I think it was I want to say 96, 97. What was happening was U.S. non-resident aliens, this is still the case today, can sell intangibles, US stocks and bonds at no capital gains. So there was kind of a little loophole where someone would come in, very common actually, someone would come in and start a US business, build it up. Like, let's say they already knew the plumbing business or they knew the real estate business. They come here, they say, you know, I already know this business. I'm going to build, I know how to build it up. I know how to sell it. I know how to make money doing this. I've done it before in other countries. So all this investment would come in, which was, I think was great for the US. They build it up over a course of years. And you know what they say, the Forster would say, you know, if you sell the entity after you go back, so you're no longer a resident, you go back to where you came from, another country, you give up your green card, you're not an income tax resident anymore, and you sell the business, the actual corporation or the LLC, no tax. It's just like selling IBM, no tax. And that was clear. The law was absolutely clear on the topic. So Bill Clinton didn't like that. You know, what happens is they get into these budget reconciliation issues. There was all kinds of things going on there at the beginning of that Clinton administration, and they needed to raise money. So as a money raising device, they went into, well, you can't come here and then leave, cut off, change your status as a resident, and then sell this block of stock, and it's tax-free. So we're going to put you under a 10-year rule, and that evolved into what we have today, which is this deemed sale. But I'm going to let Brian walk through some of the technical steps of how we get there. Go ahead, Brian.
Sure. I mean, as Gary said, for U.S. citizens, I mean, it's not as common, but there are, you know, 4 ways to, you know, to formally renounce your citizenship, and, you know, understand that this process is, you know, it's got 2 components. You have the immigration side, or at least the perspective of your actual like residence. You also have the tax side. So when the person wants to leave, you have 2 things going on at the same time, and a lot of times it's missed. But especially on the non-resident side, but even for citizenship as well, you have to formally renounce at a consulate or here in the United States or wherever. You file the right forms, but there's also a tax component that has to be followed through with. So that's for a U.S. citizen. For the non-resident, the key term here is, you know, obviously 1, you have to have a green card, and 2, you have to be deemed, or, you know, you're defined as a long-term resident. Now, what does that mean? That at 8 of the last 15 years from the date of renunciation, you have been in the United States with the green card.
Right. So if you want to stay outside the net, that's the strategy. Well, you don't want a green card.
Right.
So people, you know, the green card is really the ability to work and collect pay as an employee in the US. It's an open ability to do that. What it's morphed into because of these rules is people come in and they're not employees of their company. Of course, there's limitations on how many days you can stay here, et cetera, in terms of the immigration side. But if you avoid the net, you go back to, I can sell the stock I want in the US for no tax.
And it's also important to note the distinction between the substantial presence test, which is totally unrelated to this idea of taxation, of the exit tax. This is for an individual who has become a permanent resident with a green card. It's very important. And the substantial presence test is just an income tax deal, but don't necessarily have to have a green card to be taxable under that regime. So if you're here without a green card.
Yeah, that's a good point. So, and every time we're in a meeting, we're on the phone with a non-resident, every time. I can't imagine there was ever, it's always, no, I wasn't here 120 days in the last 3 years. It's a weighted average. we know that's if you're a US income tax resident. That is not related to the exit tax. So so basically it's a totally separate issue. This is a green card holder here for 8 years.
And it's important, and we'll discuss this later in the presentation, but there's also a distinction between income tax resident and estate tax resident based on domicile. And we'll talk about that later. But a lot of times our experience is a lot of the clients that we have, and even some of the accountants, sometimes these get mixed together. And it's important that they're distinct tests and distinct doctrines, and to walk your way through what needs to happen. But for the non-resident alien to be pulled into this net, you have to have a green card, 8 to 15 years.
Yeah. And then, by the way, the distinction between an income tax resident and an estate tax resident is something that allows for planning, substantial planning, and we'll get through that.
And then just one last thing there. Just understand as well, and this is something that we also see a lot, a green card in and of itself expires every 10 years on its face. That does not mean it's formally renounced. So if it expires and somebody leaves, they haven't left, they haven't expatriated. This is, again, that's just the way this works. We had a case where this occurred where it expired and they left, and they thought that was all they had to do, and that's not the case. You have to formally give up your green card.
Well, yeah, and that may require other explanation, but what we're getting at is you're still a resident for income tax purposes. When you formally give it up, you're not, but it triggers the exit tax. It's a little complicated, but the exit tax is what we're dealing with.
But the expiration of the green card alone is not enough. That's right. That's the point.
Right.
Okay. Now, the idea behind expatriation and the idea that the government was concerned about when they passed these laws was that when an individual leaves at that point, after they're out, they lose jurisdiction over all non-US assets when it comes to taxation. And it's very similar to when you use if an individual that is in the US, they use a foreign trust to put assets outside of the United States jurisdiction. The idea is the same. It's sort of like a mirror. Mm-hmm. But the idea here is that if you decide to leave and you meet certain criteria, then they're going to tax you. And it's a deemed sale on the worldwide assets at that time. And that is the exit tax. That's just one component on the income tax side. There's also a corresponding, I don't want to say it's an estate tax, but sort of a gift tax in a way to where thereafter, a person who has been subject to this regime, if they then give property to a US individual, you have the inheritance tax.
And when we say worldwide assets, we mean worldwide assets. It can create a terribly unfair result for someone who, for instance, has $100 million in Brazil or assets in Brazil and $2 million in the States. Because when you trigger the exit tax, it covers the assets in Brazil.
And even though it's a deemed sale too, I mean, it's not even like they just say you owe X amount of dollars. Mm-hmm. So I mean, and then not only that, but then later on, years later, let's say you buy something else that the non-resident has, and they want to give it to their kid or their niece or their nephew or their grandkid in the States, they make that gift. There's an inheritance tax, and what that means is that the donee, the recipient of the gift, pays 40% on the value. Mm-hmm. It's crazy, but that's how it's set up, because the idea is they thought when they developed this that if you expatriate and you try to give assets back, you're trying to get around our estate and gift taxes. That's what this is. The logic behind it.
The problem is you become a different taxpayer, and they want to bring you back to be the same U.S. taxpayer again.
So there's a lot of pitfalls here, but there's also a lot of potential for planning, and that's something that we will get into. just here, I mean, what does the exit tax actually mean? We keep saying deemed sale. Well, what it means is that on the day you formally renounce, the IRS takes a snapshot of all your assets in the US and worldwide, and it's as if you sold them for fair market value on the date that you left. So, you know, that's the rule. And then on the other side of that, on the inheritance taxes we discussed a minute ago, if a person, the expatriate that leaves, if they're considered covered, which means that they went through the regime and they paid a deemed sale, any gift after to a US resident, the inheritance tax applies to that gift, a 40% flat tax on the value.
And it's applied to the US donee, which is different from the
Right.
regular gift tax.
Right, and and the reason behind that is the US has jurisdiction over the US donee recipient. Now, what does all this means? Well, you know, from the perspective of the non-resident alien, when they come here and they get their green card, the date that they get the green card is called their residency start date, or the RSD. That date is important because that's where you measure if they fall under this regime or not for the 8 years. So it's important to know what that is. It's also important on the other side of this, which I'm not going to discuss today, but if they do pre-immigration planning and they come in the United States and they get the green card, that's also a very important date. And so it's important that you know that when you're speaking with a client, that you can determine, do they fit under this tax regime or not?
Yeah, for the group and the family or the patriarch with most of the assets offshore who wants to live here under a green card for some extended period of time, that starts the clock ticking. They will not be under that green card living here in 8 years.
Right. The other thing is too, it's important to note the differences between the tests between on the income tax side, which is subtitle A, and the transfer tax side. They're different. So keep that in mind, but they're both important. And it's really important from the perspective of the transfer tax side. There are planning opportunities for the long-term resident before they expatriate if they domicile themselves in another country, but they still, for income tax purposes, are taxed under the US regime.
So the domicile governs the estate. If they leave, even though they're still under the green card, you know, umbrella, they're US income tax residents. But if they leave, they're not, and they evidence the fact that they don't intend to stay and come back and stay in the States, they can make gifts. If they die, whatever's offshore is not subject to the US estate and gift tax net. And as Brian's going to get into, we can use that as planning to get into one of the exemptions from the mark-to-market exit tax, the income tax. There's a net worth exemption, and one way you get the net worth down is to make these gifts. And if you make the gifts while a non-resident alien, you're all set.
And it's important too that any long-term resident that has substantial wealth should definitely go through an analysis and a planning before they do it, because there are definitely ways to potentially avoid this regime before they do it. A lot of times they end up coming to us after they've left.
No, that doesn't happen. Yeah, that doesn't happen.
Yeah. What do we do? So also too, just to reiterate, domicile is both intent and physical presence. That's the test for the estate and gift. We already discussed what this means. So the actual act of surrendering the green card, that's the termination date for when it applies. And we explain why. Just there's a little bit of thing here where, Section 877 was what in the 90s they had imposed on this type of transaction. It's important because a lot of the definitions that are utilized under 877A, which is effective after 2008, it's still in the code, it's still there. So it's important to understand what it did, and then some of the things that it brought over, and also some of the changes. So we're gonna briefly touch those. Gary, he spoke about them before, the idea of the 10-year taint, the idea that within that 10-year frame, if you left before under the old regime, they applied the tax to you, even though you had left.
So you had to basically build up the business and then plan on selling it after the 10-year taint. So you leave for income tax purposes, for the green card purposes, you give up the green card and you let 10 years pass. So it was a little bit of a strategy you could do, which they eliminated.
Right. And then now, I mean, now that we're in 2021, I mean, really 77A is the only thing that applies now. Most of the individuals that were under the old regime, which was for 4 years, that's gone now. But it's important for the definitions and the understanding of how things apply. So the exit
there was
tax,
a period, and there was a period of time where we were doing both analysis,
we were doing
because
both.
you know, it's years ago, and some of each could apply. They were still in the 10-year taint, but the law had changed. That's fun.
But the new exit tax became effective June the 17th, 2008, and that's the current regime that we're under. But just on the old side, as we discussed, there was a 10-year period following expatriation, to where if something was sold, the non-resident who had left would be taxable. Things like intangibles. That was really the main thing. And then this is important because these tests moved over into 877A, the exit tax. So these tests are the same, and it is. So when an individual leaves, the IRS looks at three things. One is, what is their annual net income tax for the 5 years ending prior to expatriation? So what is their gross, income? What is it? And it's indexed, it goes up each year. I think for 2021, it's 172K. So the last 5 years, you have to look at that. That's one test. If you avail that test, you're covered. You're a covered expatriate. The exit tax applies. The other one is the net worth test. If you have more than 2 million in value of assets at the date of expatriation, you're covered. And this is what we discussed before.
You're not exempt, is what you mean.
You're not exempt. So if you don't plan and get your net worth down and you leave, you're pulled into the net.
If you make too much money, you're pulled in. You just have, it's not it's not these are the exemptions, fill one and you're all set. If you don't fill them all, you're pulled into that.
Right. And then lastly, even if the non-resident or the citizen meets, is below the thresholds of these two, if they don't file the correct tax form, they're also pulled in. So it's a three-pronged deal you have to do. Make sure you're under the threshold for these both of the values, and then you have to file the right forms. On the tax side, this does not matter on the immigration side, the forms that are filed. This is for the tax side. They're two distinct things. We talked about the 10-year taint, and then what happens. Basically, it converts things that would normally be tax exempt for a non-resident and makes it taxable.
You basically are considered to be a U.S. person, right, for 10 years.
Right. And it was really for the intangibles. That was the main thing it focused on. Just understand that, this, and the idea of this moved into the exit tax, that certain things, even if they were outside of the United States, it might be pulled into taxation during this 10 years. And that was just one of the things that they thought was appropriate when they did it. This moved on to the exit tax, to where they just said everything you own worldwide, deem sale. And that's what happened with the main change. So there's no longer a 10-year time frame. If you leave and you're covered and you're pulled into the regime, you get taxed.
Amazingly, people do this without a tax analysis. It's absolutely amazing the wealth of some of the people that have come in who did not, maybe they threw a stick at it, maybe they had someone they used who did their non-resident tax return or something like that, and had no analysis done. And it encompasses everything in the world that these people own. And it's just such a shame to see this trigger pulled on this thing. We've worked some of them out, but it's really serious. If you're a CPA or you're a tax advisor out there, and you see that someone's under a green card and they have some substantial wealth, the planning is imperative.
So the current regime, the exit tax 877A in the code, it applies, as we had said, it's both for the U.S. citizens and long-term green card holders. That's what a permanent resident is. It imposes a mark-to-market, so a deemed sale on all the unrealized gain on the worldwide assets. And then if that applies, then any gift thereafter back to a U.S. beneficiary, there's the inheritance tax, because it's in a covered gift or bequest. As you can see, these have stayed the same. Income tax liability for 5 years. It's now it's indexed 172K. The net worth mysteriously has stayed the same the entire time. It's not indexed. And then if you fail to file your form 8854, you have failed on the tax compliance side.
You have to be careful with this compliance issue. We've seen that a number of times as well, where someone may have come in under the 2 million. They don't make that much money annually. They could have slipped through, given up the green card, gone back, not been subject to any deemed sale. There's no appraisal issue. They kind of could have walked away from it, but they didn't certify. They didn't technically comply. So it is a deemed sale.
Yeah,
it's something to keep in mind.
Now, it's interesting that when this occurs, as of the date of expatriation, they treat the individual as if they died, basically, and they value the fair market value of all the assets for the deemed sale. This is an income tax.
It's as if they sold it.
Right, right. Now, the individual who is covered and is subject to the deemed sale does get a credit against tax due, which is for 2021 is $744,000. But anything above that, they're paying tax on to the government. There are some special rules that relate to certain types of assets, but
pension plans,
right?
Kind of thing.
And and just obviously, a green card holder can make an unintended expatriation if they don't know what they're doing. So please keep that in mind.
A treated position, yeah.
Okay, so that's the exit tax income side. This is the transfer tax side. So a non-resident's here, they've expatriated, they were pulled into the regime because they failed one of the thresholds. They paid a deemed sale tax. They leave. 5 years from now, they want to give money to their niece in the United States. They make a gift of $100,000. That is a covered bequest. That means that the niece in the United States is only going to get $60,000. $40,000 is going to go to the government.
Not only that, the niece now is in the net. The niece owes the tax.
Right. She has to pay the tax herself. So unlike every other tax on the transfer tax side, this is a donee tax, not from the donor, person that made the gift. It's for the recipient of the gift, which is I think it's unique. I don't think there's anything else we have like this inside the subtitle B of the code.
Well, they have to, because they're trying to grab whoever's in the U.S.
Right.
The person who's left already. This thing. Good luck with that. I think also it's pretty onerous. There's exemptions and exceptions with respect to the assessment of gift tax, and a lot of them will not apply to this. It'll attach pretty quickly.
What's also interesting about this, unlike the estate tax, there's no step up in basis, even though you pay this tax. So if a U.S. like donee gets stock, let's say, and there's appreciation there, not only do you pay the 40% tax, when they turn around and sell it, they're still going to have capital gains.
Yeah, if they didn't pay the exit tax on that asset, you know, within a short period of time, you're going to have gains.
Right. So
Exit tax will give you the step up.
it's a double taxation there. And like I just said, there's no step up for basis. So again, this is something that is there. It can be bad for the U.S. donee. So if this is going to occur, it's probably better to give U.S. cash because it has its own basis.
This is a classic kind of ignored tax, this inheritance tax. Very few people, even I would say in the country, we do these seminars all the time. We deal with people all over the world. Almost no one is aware of this inheritance tax. Of course, it's because you've already taken the step to expatriate. You know, the number of people expatriating is fairly limited. But no one understands that when money goes back to family in the States, that there's an additional tax on the money. It really doesn't come up that much during the life of the donee. I think it's going to hit a little more on these super wealthy when the donee dies and they take a hard look at the estate. If it's a taxable estate, they're going to trace that asset and they'll work it back to the inheritance tax, and you're going to have a massive penalty and interest issue as well.
Right. And if any U.S. resident receives a gift from a foreign resident and it's over a certain threshold, they need to report it to the IRS. That's how they match.
It's a 3520, right?
Right. So keep that in mind as well. Also, this inheritance tax also applies to a foreign trust. Mm-hmm. So it might not occur at the time of the transfer, the funding of the foreign trust, but at some point, if a distribution is made back into a U.S. beneficiary, this tax might apply. So that's something to keep in mind and understand. It's a lot like the GST tax. There's a ratio when you calculate the amount of the gift and then all these things. But that's the regime behind it. It's very like, you know, this is how the idea of the inclusion ratio. So every gift from a trust, if it's in there, it pulls it in, and then you have to pay this tax. And
if the beneficiary is the U.S., right, and then they start to do ratios as who's getting what. Right. Interesting. This tax applies to assets acquired after expatriation. If you think about that, so someone pays mark to market on the expatriation, and the code kind of suggests, well, we also don't want those same assets coming back into the U.S. You know, if they were non-U.S. situs, and someone saying, look, I'm foreign, it's non-U.S. situs, it's not a gift, I don't have to pay tax. So they limit that workaround. But when someone's non-U.S., they're gone. They pay the mark-to-market tax, and they buy stuff outside the country. It still applies. Right. It still applies. It's very onerous.
And then there is an exception for a foreign trust. The foreign trustee may file a form with the IRS and elect to be treated as a domestic trust.
Yeah,
that's one way around it potentially, but that might not work for other reasons. The logic behind this is they don't want people taking steps to avoid tax. So if you're here and you leave, you exit, and then you give money back, the idea is that you're basically trying to avoid the estate and gift tax, and so they impose this tax. That was the logic behind it. I think the problem with that, though, is even though the U.S. donee pays the 40%, there's no corresponding, you know, the tax itself does not cause the basis to step up, unlike the exit. The exit does, because you get a step up on the deemed sale. But if it happens long after, or an asset that was, you know, it was acquired and then, you know, it went way up in value,
and it doesn't expire,
it never goes away.
So you just can't give assets back in the U.S.
Right. Basically forces them to leave, those individuals perhaps to leave.
Yeah. Which was not the intent.
which is not the intent, but Congress very rarely understands these things.
Yeah.
But it's good though, because it allows us to plan too.
Yeah, definitely.
Just some definitions, you know, when we say expatriate,
Look at their sign right on that thing.
yeah, and one that's covered, just, you know, so just so you understand terminology, that's all that means. Did they fail this test or not, these thresholds, or did they fail to file the correct tax forms? If they're covered, then it's something that they're basically tainted with for the rest of their life. So if they ever make a gift back to a US Benny, that you're paying tax each time. Okay. There are some exceptions to this. Just be aware, if you have a US taxable gift that's inside the United States, for instance, you know, if something like US real estate or something, and they give it to a US beneficiary, they're paying gift tax on that. So that would not be part of 2801. Things like that. And you can see some of the other ones make sense. Charities, a spouse inside the United States. Okay. And we already said the donee is the one that pays, which is unique. This is just the calculation. You have to add up all the net covered gifts in a year and the highest estate tax rate or gift tax rate, depending on what it is. When they're unified, that's not a big deal. But if they decouple the estate and gift credit, which they're currently talking about right now in Washington, it would affect this. Just keep that in mind. Okay, so now we have an overview on what these taxes are. What can you do to avoid them? That's really the practical thing here. What are we trying to do? Well, if someone's trying to leave, you have to be aware of two things. One is, what is their net income tax liability? What have they earned over the last 5 years, the average? So maybe they're able to plan to get their income down, so they fall below the average. On the wealth side, maybe there are ways to gift foreign assets to get their net worth down below 2 million. Because as we said, the US green card is an income tax thing. You can be domiciled in another country outside the United States. So on the estate and gift side, if you're domiciled somewhere else and you decide to make gifts of non-US assets, you can make those gifts and not pay US gift taxes.
And you have reduced your net worth.
Right. So it's something to keep in mind. The other thing that you're able to do, this is especially true if you're a US citizen, you can create an expatriation trust. You can use your credits that are here, which right now is 11.7 million. Gift these assets in an irrevocable trust, then it's outside of your estate. You don't own it anymore. You avoid estate and gift taxes, then you expatriate because your net worth has been reduced by the gifts that are now out of your estate. We talked about domicile, being able to leave. That might work for some individuals. The sale of a personal residence is also good because it's exempt from income tax under 121 up to $500,000. Now you do have the value issue potentially, but you can also gift that and use the unified credit before you leave. And then there's also all of the historic stuff we've done on the domestic side to get things down, grats, idjit sales, get things out of the estate of the individual. Because when you expatriate, they treat the person that expatriated as if they died and they value all of their assets. That's why this is important. There's some stuff here. I mean,
it's the same idea.
I guess
Gifting
the
out.
same. Yeah, I
Charitable donations is also good.
Right. why does this matter? Well, a lot of our clients, when they're expatriating, a lot of times they want to utilize different strategies to get their wealth down because of the $2 million tax.
So, and you use the distinction between the wealth tax, the estate and gift tax, and the income tax by becoming a non-resident for estate tax purposes. If you've got a lot of foreign assets, if you don't have a lot of foreign assets, you use up your huge exemption now, which may change, and get your assets down and possibly negate the impact of the deemed sale.
Which right now was 11.7 million. It's likely to go down. I think it's likely to be half now. That's what they're saying right now. And then of course they can also use the stuff, annual gifting, things just to get their net worth down.
What we're getting into, by the way, is we're kind of segueing into now not just people, but assets out. So let's say you wanted to stay, you're not worried about exit tax or this idea of leaving the country and sending assets back in, the inheritance tax, but now we're thinking about moving assets out of the country. And actually it comes down incredibly, it comes down to kind of one slide. You know, and it's kind of complicated, but the idea is a lot of people now are moving toward, I want to put my stuff out of the country. Maybe later I'll leave, but I want to start putting my stuff out of the country in a foreign trust.
Right. As we know, trust, there are two types of trust. One is an independent tax-paying entity. Another is considered a grantor trust, which means the person that made the trust, created the trust, is treated as the taxpayer, so the trust is disregarded. That's important because if you have a U.S. resident that creates a foreign trust with U.S. beneficiaries, it will be a grantor trust. That's why it's important to understand these basic rules of why U.S. persons, which also includes trust, pay income tax on worldwide income. Likewise, a U.S. person that's domiciled here, they're taxed on any gift of any worldwide asset if they're domiciled here.
Mm-hmm.
We had touched on these briefly before. If you're a non-resident, there is exceptions to the U.S. income tax rules for certain types of assets. The main one are the stock sales. That's the main.
Mm-hmm. So intangibles like stocks can be transferred without, there's no capital gains. If you're a non-resident, there's no capital gains on intangibles. If you do sell an intangible or a company stock that's mostly real estate, there's a separate FERPTA tax. It's a graduated tax for that. And the same is true on the estate side. You can give away intangibles at no estate or gift tax. I'm sorry, no gift tax. If you die with the intangible, it's bad. It's bad. That's Brian. You don't want to hear Brian say it's bad.
Well, yeah, because
if you die with it, it's part of your estate.
A non-resident only has a 60,000 K, 60,000 unified credit amount. Everything else is taxable. 40% has not changed. It's been that way for a long time. So you never want to have a non-resident die with U.S. stock.
And it's surely not changing now.
Yeah, definitely not changing now. Foreign trust, they're taxed on certain things if it's U.S. based, but otherwise it's not taxable if it's non-U.S. income, because they're a non-resident alien for income taxes. Just that if they distribute money into the U.S. Benny would pay tax. The estate tax we talked about. Beware of treaties. Sometimes something also to take into account. Yes, you can domicile plan, but beware of treaties.
Well, use the treaty.
Or perhaps use it. You need to know it.
Utilize a treaty. You can sometimes use a domicile treaty, domicile in a country that the treaty says, okay, if you're domiciled in that country, that treaty's laws govern. Domicile in the country that's got the better laws.
very quickly, we're just going to run through the basic. If a U.S. resident wants a foreign trust, how is that taxed?
How is it
funded? Funded, and what happens? Because it's important, because you have two things going on: income tax side and estate and gift side. So if a U.S. individual person makes a foreign trust, it's important because depending on where it's located, which is going to be offshore, is the idea. So it's going to fail one of the tests, either the court test, which is can a U.S. court bind trust operations, and then two, where's the trustee? If it fails either of those or both, it's considered a foreign trust offshore. And that's important because on the income tax side, I'll discuss here in a minute, you might have a deemed sale on the transfer of assets into the foreign trust.
And that's kind of the asset transfer issue.
Right, because you're basically expatriating those assets outside the United States. And then on the estate and gift side, have they completed the gift or not? And that's also important.
Really important.
Because, yes, and we'll explain why. Just be aware that non-residents have their own rules on the income and on the estate side. And the big thing is the 60,000 amount for the unified like amount against tax. Also, with real estate, just as an aside, a foreign resident should never own U.S. real estate individually ever.
And really, there's a fairly simplistic strategies to completely eliminate any U.S. based holdings. We can just eliminate it through holding them through an entity. So that this idea of U.S. situs assets and dying with U.S. situs assets or giving away U.S. situs assets is relevant, but can be avoided through proper planning.
Now, where the rubber meets the road for the foreign trust is this, and this is a lot of times what we will see the majority of the time. You have a U.S. individual who's here. They want to create a offshore trust, perhaps for asset protection. Maybe they want to expatriate. It doesn't matter. They do it, but they have U.S. beneficiaries of the foreign trust. That is important because even though the general rule is when you create a foreign trust and you fund it, you transfer things into that trust, there's a deemed sale on those assets going into the trust. The exception to that rule is if there's a U.S. beneficiary of the foreign trust and you have a U.S. deemed grantor, then that is postponed. And it is a grantor trust until the earlier of A, the grantor dies, or B, there's no longer a U.S. beneficiary of the foreign trust. And that's important because you put off the deemed sale. That also gives planning opportunities when it's done, because the idea being that is so even if you complete the gift for the U.S. estate and gift, and the person's given up all control over the asset, that's on the estate side and gift side. The income tax side, when they die, there's going to be a deemed sale on those assets.
So you have to be very careful that really what happens is we have U.S. people who form foreign trusts for asset protection purposes because the U.S. person's almost always going to have a U.S. beneficiary. So that trust is what's called grantor, and most of the CPAs online understand that. Grantor means it's disregarded for income tax purposes. So it's just treated as if it's the grantor, right? So there's no sale or transfer issue. There's no gift issue. There's no capital gain issue. And then keep in mind that this transfer tax and the exit tax, this is the exit of asset. They're all income tax issues. They're not estate tax issues except for that inheritance tax. So there's no transfer under 679. It is a grantor trust. The 684, which otherwise would tax the transfer as a deemed sale, is deferred. The way they defer it, though, you got to be very careful. They defer it until the grantor dies, and then the deemed sale hits. So you have to be very careful with the completed gift on this stuff. So if you complete the gift to a trust, that means you give up control of the asset for somebody else. You're not taxed at death, and you don't get a step up in basis. So if you're taxed at death on these assets in the foreign trust, basis steps up. The deemed sale doesn't matter because you don't have any gain.
Right.
But if you transferred assets to the foreign trust as kind of an estate planning mechanism, which I've seen done, you transfer out, you don't get the step up. You've completed your gift, and so when the grantor dies, you're going to have a deemed sale at death, and it's brutal. It's brutal. So there are ways to deal with that, to actually negate that, but that's probably a different seminar. But just to keep the issue in mind, if you ever see these things come up, they have to be addressed.
Okay. We might have some questions there. I see.
Okay, great.
Up there. Take the mouse up there, and it says the chat up there. Do we have any?
I don't think so.
Okay.
Doesn't look like we have any questions. Tony, do we have any?
Yes, I see a question here, so I'll read it for you. Okay. If a citizen has not lived in the U.S. for years and has no assets in the U.S., derives no income from the U.S. and only does business outside the U.S., then renounces with no intent of returning, what effective enforcement is there for collection since nothing is left to leverage in the U.S. jurisdiction? So they have nothing, they leave, and then they want to renounce later.
Right. Thanks, T. That's a great question. That's not really a legally, you're gonna have your deemed sale. They have to go through. Remember, they have to go through the process to create the deemed sale. So they're going to submit all of that information to the IRS. Obviously, they've got the INS application, and that information is going to lead them back to those assets, and then enforcement becomes through either a tax information exchange agreement or a treaty. So depending on the country of residence, the IRS can either go there directly, less common though, or give notice to the local jurisdiction, and the local jurisdiction can collect the tax for the IRS. It's not that uncommon. That's how it's done.
And then any future gift to a U.S. beneficiary, even if they're under the amounts, the income and the threshold amount of wealth, any gift from then on would be 40% tax to the U.S.
recipient.
Right. So I don't want to do that.
Any more questions, Steve?
I don't have any other questions.
Okay, outstanding. Thanks for attending. We appreciate it. If you'd like a copy of either the asset protection book or the book on estate and gift tax and the non-citizen, or a copy of the presentation or the outline, just let us know. Our email's there, our phone number's there. And thanks so much for attending.